The financial world, much like the natural world, is prone to sudden storms. These storms can arise from a variety of sources, be it economic data releases, geopolitical tensions, or unexpected policy announcements. Each event has the potential to send ripples through the markets, creating waves of volatility that traders must navigate with skill and precision. In early April 2025, one such storm erupted in the form of President Trump's announcement of new tariffs targeting Japan. This announcement was not entirely unforeseen, as trade tensions had been simmering for months. However, the scale and immediacy of the tariffs caught many off guard. These tariffs, initially set at a hefty 25% on Japanese car and truck imports, sent shockwaves through the global marketplace. The automotive industry, a significant pillar of Japan's economy, was particularly hard hit. Companies scrambled to assess the impact on their supply chains and profit margins. The aftershocks were felt most keenly in the volatile realm of Forex, where the USD-JPY currency pair became a focal point of uncertainty and opportunity. The Japanese yen, often seen as a safe haven currency, experienced significant fluctuations as traders reacted to the news. Traders, always on the lookout for catalysts that can shift the tides of currency valuations, watched closely as the USD-JPY pair reacted to each twist and turn in this unfolding trade drama. The initial reaction was one of sharp depreciation of the yen, followed by a period of heightened volatility as the market digested the news. This essay delves into the impact of Trump's tariff measures on the USD-JPY pair, offering both a fundamental and technical analysis of this crucial currency cross. We'll explore how market participants interpreted the tariffs and adjusted their positions accordingly. We'll retrace the events leading up to the tariffs, examining their immediate effects on the market. From the initial announcement to the subsequent reactions from both governments and corporations, each step played a crucial role in shaping market sentiment. Then, we'll equip you with the tools of technical analysis, pinpointing key support and resistance levels that can guide your trading decisions. Understanding these levels can help traders identify potential entry and exit points, manage risk, and capitalize on market movements. But navigating the turbulent waters of Forex requires more than just technical prowess. It demands a deep understanding of market psychology, the ability to stay calm under pressure, and the discipline to stick to a well-thought-out trading plan. It demands a steadfast commitment to risk management, a principle we'll emphasize throughout this analysis. Effective risk management involves setting appropriate stop-loss levels, diversifying positions, and avoiding over-leveraging. By the end of this essay, you'll be better prepared to not only understand the forces at play but also to develop a sound trading strategy for the USD-JPY pair in this era of heightened trade tensions. Whether you're a seasoned trader or a newcomer to the Forex market, the insights and strategies we discuss will help you navigate the complexities of trading in a world where economic policies can change in an instant. To understand the current state of the USD-JPY pair, we must first trace the footsteps of the giants locked in this trade battle. The story of tariff tensions between the United States and Japan is a complex one, filled with strategic maneuvers, economic calculations, and political posturing. It's a tale that has had significant repercussions not just for the two nations involved, but for the global economy as a whole. The tension began escalating in early April 2025, when President Trump, known for his protectionist stance, set his sights on Japan. His administration had already been involved in several trade disputes, but this new focus on Japan marked a significant shift in strategy. On April 2, 2025, the first salvo was fired. Trump announced a 25% tariff on all Japanese car and truck imports, a move that sent a chill down the spines of Japanese automakers and rippled through global supply chains. This decision was not made in isolation. It was part of a broader strategy to reduce the U.S. trade deficit and bring manufacturing jobs back to American soil. The initial shock was amplified by Trump's suggestion that a 24% tariff on all Japanese goods could be on the horizon, a threat that cast a long shadow of uncertainty. Businesses on both sides of the Pacific began to brace for impact, with many scrambling to find ways to mitigate the potential fallout. Markets reeled from the news, with the USD-JPY pair exhibiting heightened volatility. Investors were caught in a whirlwind of speculation, trying to predict the next move in this high-stakes game of economic chess. The currency pair, often seen as a barometer of market sentiment, swung wildly as traders reacted to each new development. However, the storm momentarily subsided when Trump, perhaps in a strategic maneuver, opted to temporarily lower the proposed tariff to 10%. This move was seen by some as a gesture of goodwill, a way to bring Japan to the negotiating table without causing immediate economic harm. This relative calm, however, proved to be the eye of the storm. The temporary reduction in tariffs did little to ease the underlying tensions, and many feared that it was only a matter of time before the situation escalated once again. On April 5th, the baseline 10% tariff on Japanese goods came into effect, a stark reminder that the trade war was far from over. The implementation of these tariffs had immediate consequences, with prices of imported goods rising and supply chains experiencing disruptions. Subsequent meetings between US and Japanese officials yielded pronouncements of progress, but no concrete resolutions emerged. Diplomatic efforts were ongoing, but the path to a comprehensive trade agreement remained fraught with challenges. Trump, true to form, took to social media, punctuating his messages with pointed reminders of tariffs, military support, and trade fairness. His tweets often served to inflame tensions, adding another layer of complexity to an already volatile situation. The uncertainty kept markets on edge. Investors and businesses alike were left in a state of perpetual anxiety, unsure of what the next day might bring. The constant flux made long-term planning nearly impossible, and many companies began to reconsider their investment strategies. Each news cycle brought a fresh wave of speculation, further fueling the volatility of the USD-JPY pair. Analysts and commentators dissected every statement, every tweet, looking for clues about the future direction of trade policy. As traders grappled with the unpredictable nature of the situation, one thing became clear: the trade war was far from its conclusion, and its impact on the Forex market was only beginning to unfold. The ongoing tensions between the US and Japan would continue to shape the economic landscape, with the USD-JPY pair remaining a key indicator of market sentiment. In the ever-shifting landscape of Forex, technical analysis serves as a compass, helping traders navigate through uncertainty. For the USD-JPY pair, particularly in the wake of the tariff storm, understanding the technical signposts is essential. A glance at the charts reveals a telling story. As of April 19, 2025, the USD-JPY pair is trading at, insert live price here, pull from a live chart. This price point, however, only tells part of the story. To gain a deeper understanding, we need to look at the trends and key levels that are shaping the pair's movements. The overall trend, as indicated by the recent price action, suggests a downtrend-uptrend. Analyze a live chart to determine. This trend is further confirmed by the position of key moving averages, such as the 50-day and 200-day moving averages, which are currently describe the relationship above or below the price and each other. Crucially, we observe strong resistance at the insert resistance level from your chart analysis level. This level has acted as a ceiling for the pair in recent trading sessions, indicating that upward momentum is being capped. On the downside, we have key support at the insert support level from your chart analysis level. A break below this level could signal a further decline in the USD-JPY pair. Armed with the insights from our technical analysis, we can now begin to map out a potential trading strategy for the USD-JPY pair. This process involves identifying key levels of support and resistance, understanding market trends, and recognizing potential entry and exit points. By doing so, we create a structured approach to trading that helps mitigate risks and maximize potential returns. Keep in mind that this is not a guaranteed roadmap to riches, but rather a framework to guide your decision-making in this uncertain terrain. For a short position, you need to be vigilant and ready to act when the market conditions align with your analysis. This means continuously monitoring the charts and being prepared to execute your trade when the right moment presents itself. For traders anticipating a further decline in the USD-JPY pair, a prudent entry point would be on a confirmed break below the support level identified in Section 3. Level. This level acts as a critical threshold, and a break below it could indicate a continuation of the downward trend. It's essential to wait for confirmation to avoid false breakouts, which can lead to premature entries and potential losses. Place your stop-loss order above the resistance level slightly above entry. This stop-loss acts as a protective measure, ensuring that if the market moves against your position, your losses are limited. It's a crucial part of risk management, helping you to preserve your capital for future trades. This acts as your safety net, limiting potential losses if the trade moves against you. By having a stop loss in place, you can trade with more confidence, knowing that your downside risk is controlled. This allows you to focus on identifying and capitalizing on profitable opportunities without the constant fear of significant losses. Target the lower price target based on chart analysis level. This target should be based on your analysis of the market and the potential for further price movement. Setting a realistic target helps you to lock in profits and avoid the temptation to hold on to a position for too long, which can lead to missed opportunities or increased risk. You can adjust this target based on your risk appetite and market conditions. Flexibility is key in trading, as market conditions can change rapidly. By being willing to adjust your targets, you can better align your trades with the current market environment and your own risk tolerance. For a long position as an alternative, consider the potential for a market reversal. This involves looking for signs that the downward trend is losing momentum and that a new upward trend may be beginning. Key indicators can include bullish candlestick patterns, positive economic news, or changes in market sentiment. If the USD JPY pair shows signs of a reversal and breaks above the resistance level identified in Section 3 level, it could signal a potential buying opportunity. This breakout above resistance suggests that buyers are gaining control and the price may continue to rise. As with short positions, it's important to wait for confirmation to avoid false breakouts. In this scenario, place your stop-loss order below the support level, slightly below entry, to manage your risk. This stop-loss placement helps protect your position if the market reverses again and moves against you. By setting a stop-loss, you can limit your potential losses and ensure that you maintain a disciplined approach to trading. Target the higher price target based on chart analysis level. This target should reflect your analysis of the market's potential for upward movement. By setting a clear target, you can plan your trade more effectively and ensure that you take profits at an appropriate level. Again, adjust this target based on your risk tolerance and market conditions. Being adaptable allows you to respond to changes in the market and optimize your trading strategy. Remember, the goal is to maximize your returns while managing your risk effectively. Remember, this is just a framework, and you should always adapt it to your own trading style, risk tolerance, and the prevailing market conditions. Successful trading requires continuous learning and adaptation. Stay informed, be flexible, and always be prepared to adjust your strategy as needed to navigate the ever-changing market landscape.